At this point in time, everybody and their mum knows why markets have been falling across 2022. Inflation is sky high, and that in and of itself is enough to destroy economies alone. Then on top of that, we have supply side shocks from the war in Ukraine, from China and their weird zero COVID policies, and a number of other supply side issues as well. The really important thing these days that isn't any of that though is plain and simple. It's the Federal Reserve and their tightening of monetary policy. The Fed has now been hiking interest rates for months on end, and they've been doing so at a pace never before seen in history. Quantitative tightening has also come into the fray, and that's been used to replace quantitative easing, and that's also having a massive effect on our asset prices and our investments. All eyes right now are on the Fed then, because they truly do hold the keys to whether or not the markets go up or down these days. Many people have now repeatedly been calling for the Federal Reserve to pivot, for them to change their minds about inflation, for them to stop hiking interest rates and start slashing them in order to try and put growth back into the markets and to save people's investments and more likely a few hedge funds. The problem with this idea, though, is sadly blindingly obvious. Inflation is not at all over, and if the Fed were to pivot, to turn around at this point and to change their minds, if they were to turn the money printers back on, inflation would well and truly spiral out of control, and we might just see the first true hyperinflationary period in American history. Over the last week or so then, a lot of eyebrows have been raised because on the surface, it looks like a pivot might just be here. The US Treasury Department has started making its first steps to fight against the Federal Reserve to try and implement maybe even their own warped view of quantitative easing to try and save the markets and, more importantly, the Democrats from a very difficult election cycle. Now, this story is absolutely shrouded in smoke and mirrors, and it's really quite incredibly difficult to know exactly what's going on because legacy media outlets everywhere seem to be doing everything they can to bury this story. But today, I'm going to do everything I can to break it down as basic as I can make it, to show you all exactly what's going on and to tell you exactly what it means. So what exactly is the news? Well, earlier on in the week, we got this piece here coming out from a few different places. The US Treasury asks major banks if it should buy back bonds. Now, the different articles covering this vary, of course, but the gist of the story is as follows. The US Treasury Department is going around and speaking to a bunch of different major banks and asking them if the Treasury Department should be buying bonds off the open market to try and improve market liquidity. These banks seem to be very worried about the bond market these days, and the Treasury thinks that this might help. Now we have the idea coming back from the banks that they actually seem quite receptive to the idea, that they like it, and they're sort of trying to push the Treasury in that direction. The Treasury also seems to be quite optimistic about it and is now pushing a bit further too as well. After this good feedback, they're looking for more questions. They're asking things like, how should the Treasury actually structure this program? What are the benefits and the drawbacks of this kind of program? And could the Treasury even make money for the taxpayer in the form of investments through this idea? Basically, what we're seeing is bond yields rising across the board, and on some less popular notes especially, like the US 20-year Treasury note, yields are rising even faster. Obviously, as yields rise with bonds, the prices of those bonds are actually decreasing, so banks who own them are losing money. The Treasury is now speaking to the banks who are basically saying, help us, we're drowning, and the Treasury is slowly leaking information into the wider market to try and get some sentiment going to find out whether or not this would be appreciated by investors. Now, about 3 days after we got that first set of articles covering this idea, we then got a second set of articles covering this idea again, like this one by Bloomberg behind me here, Momentum Builds for Creating a Bond Buyback Program. Now, the Treasury is asking for more frequent and more detailed analysis from those banks into what this program might do. Again, they're pushing the idea out to the markets, to investors and banks to see what they think about it. And it's going to the point where investors are now betting when they think this program is actually going to start. And most people seem to think it's close to the end of 2022. To conclude then, because this is going to get very complicated, what the news today is, the Treasury is worried about the bond markets. Crashing bond prices are down by as much as 50% so far this year, and so the Treasury is thinking about buying bonds to try and move prices up and bring yields down. But what are these actual media outlets saying about this, and what does the news think? Well, on the surface, not really much at all. If you were to read this Reuters article behind me here, for example, you still won't exactly understand anything about what's actually happening because the article just reiterates the same points over and over again. The Treasury is asking banks if they should buy bonds, bond market liquidity is struggling, and things like that. One thing we can learn from these articles, though, is what a bunch of different investors think the issue is, though. Investors have noted that a major constraint for liquidity is the result of a rule introduced by the Federal Reserve following the 2008 financial crisis, which requires dealers to hold capital against treasuries, limiting their ability to take on risk, particularly at times of high volatility. The underlying cause of the lack of liquidity is that banks, due to their supplementary leverage ratios being capped, don't have the ability to take on more treasuries. I view that as the most significant issue right now. So there is this regulation that was put into place by the Federal Reserve post the 2008 financial crisis that tries to limit the amount banks risk when they own treasuries by ensuring that they have some capital set aside in case the price of treasuries collapse and the banks then collapse, as we saw in 2008. These banks are now blaming those very same rules, saying that because of them, they can't buy enough treasuries and that's why yields are rising. Now, this is a very weird argument to make, and it seems to be pushing the idea that the Treasury and the Federal Reserve are at odds with one another. This is a policy put in place by the Federal Reserve, and the Fed are keeping it in place as well, and the Treasury is now trying to help banks get around this policy. Now, firstly, this is a very weird argument to make. If this rule had never existed, then it's quite likely that banks would have just bought way more treasuries over recent years, and they would have suffered when treasury prices then collapsed 50% over the last year as the Fed started to raise interest rates. This rule actually seemed to stop them from falling into that failure and then now blaming it. The banks want less regulation as always and more risk, but the argument they're making is that this will actually save markets from collapse, and that just shouldn't sound right to you. Now, another big idea that the markets, that the media and investors seem to be pushing regarding this policy is that it totally isn't quantitative easing, so please stop calling it quantitative easing, and this article here pushes that idea a lot. This subtitle here is that the Treasury is considering buying back its older debt, a bit like recycling. They really do want people to stop calling this quantitative easing because that's scaring the markets, and they want everyone to know that this isn't anything like a Federal Reserve pivot at all, even if it would help market liquidity for bonds, just like quantitative easing, and even if it might send bond yields down across the board, again, just like quantitative easing. So the media really don't want you to think it's quantitative easing, but on the surface, it seems nearly identical to it. But how would it actually work? Well, here it's very hard to tell because this has never been done in this way before, but this is what I think it might look like after spending the last 3 days or so doing nothing but researching this. Now, firstly, I just have to clarify because, again, this isn't something we've covered before, and it's something that no one has really covered before because no one even thought this was ever going to happen. But the Treasury and the Federal Reserve are two entirely separate entities. The Fed controls the money supply via quantitative easing and quantitative tightening. They create and release bonds, or they buy and destroy bonds. The Fed can therefore literally create money out of thin air. The Treasury, on the other hand, is sort of like the bank account of the US government. It collects taxes and it pays for stuff. So money in and out of the US government, it's spending and it's revenue directly. On the other hand, then, the Treasury cannot literally create money out of thin air like the Fed can. Now, what this would probably look like is it would be the Treasury, so the literal US government, buying bonds from the open market. It would probably buy some less popular bonds like the US 20-year Treasury to try and lower the yields there because there are just less buyers for that unpopular bond, so yields are higher. But where would the Treasury get the money from to buy this debt because they cannot create money out of thin air? Well, they can do it in two ways, from your taxes or by releasing new debt. Now, we already know that the US government spends way more than they get in from taxes, so it's obviously not going to be the first one. It's going to be the latter. The Treasury is going to release new debt or sell bonds to then go and buy up other older bonds. In theory, if they bought up 20-year treasuries and sold new 30-year treasuries, the bond yields on the 20-year would go down from the 4.5-ish% they're currently at, and the 30-year treasuries would go up from the 4-ish% they're currently at. On the surface then, it really would just simply be helping out by increasing liquidity in the markets, just helping the markets more effectively price these near identical assets. But as always, I think there's far more sinister stuff at play here, and the reality of this program is far different. Now, I think there's probably two secret things going on here. The first is that on the surface, this would make US government debt appear smaller, even though the interest payments that the government pays on their debt would actually increase. If we say the Treasury buys a 30-year Treasury that it issued around 2 years ago, and I looked one up, a 1.375% coupon that matures in 2050. Well, when it was issued, someone paid the Treasury around $100 per bond for that bond. On the other hand, its market price, what you can currently buy that bond from a random person, is about $55, and that's a result of interest rates rising over recent years. Nonetheless, even though it's only worth $55 to us, it represents $100 of debt on the books for the US Treasury. Therefore, the Treasury can issue a brand new $100 bond with a coupon of 4.25%, because that's where interest rates currently are sitting, and pay off 2 or almost 2 of those older bonds. That would make their debt, the physical number of US governmental debt, go down, even though the interest that they're paying on that debt would actually go up. This would therefore categorically be bad for the US government, but it would on the surface appear good to the average person. The US government, of course, runs on debt to GDP figures, i.e. if the debt that the government has rises by 1% in a year, but the economy rises by 3%, then debt in relation to the size of the American economy has actually gone down in comparison, so it's good news. Most people, though, recognize that this is a flawed idea and a flawed metric to pay attention to, and that we should instead look at debt service costs compared to GDP, because how much that debt actually costs the government every year is far more important than the notional figure of how much the debt is worth when it comes to balancing the books. This process would then make that first ratio, the one that is actually important when it comes to governing the country and relates to things like the debt ceiling and that people will look at come election time, go down, even though the actual cost of US governmental debt would go up. That's how much interest the government or the taxpayer is going to be paying on that debt. It would actually go up. Now, this alone should be sending some alarm bells ringing, and it is very sneaky. But there is another major fear about this idea, that there may be some kind of lag or delay in between the US government buying up this old debt to make yields fall and then them selling this new debt to pay for this program. If there is a delay, if they buy up their old debt now but only start releasing their new debt in, say, a few months, then this would act as increasing the money supply in the short term, and this would basically be quantitative easing in everything but name, and it would cause inflation even more. The other thing it would do, though, is cause bond yields to drop across the board, and it would also suggest some kind of weird semi-pivot by the US government, and it would likely cause investors to jump back into the markets, and it might even cause a short-term boom or a rally in the markets. It might make asset prices rise in the short term. Conveniently, this could be done for just about long enough that the midterms would then come and go, and the Democrats might be able to perform better if the market crash stops and then turns into a market boom, and the inflationary effects of this issue wouldn't actually be seen until months or even years from now, as it takes time for this new increased money supply to get into the markets and spread around. This would also be pretty disastrous for the US, but it could cause a short enough market rally that the Democrats could then perform well in the midterm elections and save themselves from what is otherwise likely to be a massive loss against the Republicans. Again, I have to clarify, I'm not 100% sure about any of this because this is entirely unprecedented, but this does not seem like a good policy. It seems far more likely to have secret, sinister reasons behind it, in my opinion. Again, I can't prove any of this, and no one can, because we just have no idea as to whether or not this is even going to happen or how it will happen if it does, because we're just way too early, but this is something we need to pay attention to. It all seems incredibly confusing and incredibly complicated and very opaque on purpose. There aren't many details surrounding this idea on purpose. We've already seen the United Kingdom turn the money printer back on, albeit only for a moment. Many investors want the United States to do the exact same thing though, even though it's economic suicide and the Federal Reserve knows it. Could this be some kind of civil war between the Federal Reserve and the Treasury Department, one fighting against inflation and one support it, one trying to regulate the markets to stop them crashing, and one trying to help banks get around those regulations? Who really knows at this point, but I am pretty determined to figure it out. From my point of view, at the very minimum, this takes creative accounting to a whole other level. It turns out that Bernie Madoff didn't actually die, he's just working as a consultant for the US government. That is it for today. I hope you enjoyed this video and learned something. If you have any theories or ideas about this, please let me know down below in the comments. Until next time, stay stoic.